Hey guys, it's Chris Mincola with the Mincola Group over at West USA Realty, and I'm doing our weekly market update. Apologize for the allergies in advance. I'm going to go ahead and share my screen with you here, and we're going to jump right in. There's so much going on as usual, but okay. So the what I'm gonna explain to you is exactly what we're going to be looking at over the next 3, 6, 12 months. There's some good news on the horizon. We're just going to have to kind of scrape through this period as far as these higher interest rates go, but there's really good news coming up. So um, let me just share the screen here with you again, and then we'll jump right into this. Okay, let's see. There we go. Uh, okay, there we go. Okay, so this is going on. FFHA, FHFA Director Bill Pulte calls on the Fed Chair Powell to resign. And I think with good cause. I'm just going to be blunt with you. Um, I'm going to explain to you why in a minute, but there's no reason why we're doing what we're doing right now. Not only is it costing, billions of extra dollars for the entire country, in its current debt situation, which, hey, they got themselves into this, but it's also slowing down the housing market affordability for people. And it's kind of throwing a wrench into that. And there's really no reason for it because inflation is down. And, the labor market isn't horrible, but it's definitely got some signs of weakening. So we'll talk about that in a second. But this article here gets into you know President Trump and Bill Pulte are calling Fed Powell to lower the rates or resign, and we're going to see more of this over the next few months. Um, and again, I'm going to save it for later because I want you to watch what's going on here. But I'm gonna explain to you exactly what's going to happen over the next few months with interest rates. But the unemployment rate right now is at 4.2. Now we know the Fed basically wants to see a higher number for the unemployment. Right now, let's see, we're on the unemployment chart. Let's see where I've got it here. We're at like 200 and what 45,000 or whatever. They want to see that number closer to like 323 in order to set bells off, or at least over that 250 threshold. They want to see it at 4.3 to 4.5% range as far as the unemployment rate. That's coming from the Federal Reserve, Chairman Powell. Now, there's some little bit of arguments there inside the Fed. There's some that want to lower rates, some that don't. Some that want to just keep it. Some thinks they should even raise it. Some of them want to keep it, but that's kind of so they want to see more unemployment because they feel that that would keep inflation from rising more. And the whole thing is, they can lower the rate whenever they want. If inflation got out of control, I don't think we're going to see that right now. Our inflation rate is like in the low 2 point whatever. It's like 2.1, and I don't think we're gonna. We'll talk about the PCE, which is what they track. This is PCE inflation, personal consumer expenditures. That's what the Fed tracks. Headline inflation is 2.1 year over year. Their target is 2. Okay. So, um, 2.12, we're in they're using some old antiquated models. Some people think Powell's being political. It's starting to look that way, maybe, but the Fed admits it's still being restrictive, and they'd rather be late. They've come right out and said they'd rather be late, which I talked about last week, than get ahead of things. So, housing construction not growing for years. Basically, This is saying we kind of hit the peak for the decade unless something drastic changes. Yesterday, the housing starts reflected a long-standing trend that the housing construction cycle reached its peak in 2022. Okay, that's when they started raising the rates right around April, May of 2022, and since then, the progress has been quite limited. In this article from Logan Motoshami, he writes that home builders have seen hesitant to issue new permits given current mortgage rates around 7. However, if they decrease to 6, which we've seen, but not for sustained period of time, for like a year or two, that could potentially stimulate activity and encourage growth. Now, what President Trump and Pulte keep saying is they want to see this. You know, they think that the rate should be. President Trump said it was a day or two ago, 2 points low, 200 basis points lower for the Fed rate to two and a half, and I can't argue with him. I mean, he mentions other countries a lot that have lowered their rates. Inflation's way down. We've definitely had an uptick, as you saw in the chart, in unemployment. Um, so single family construction peaked years ago. You can see it's kind of dropped off. Single family starts, and the reason why this is important is this is a big portion of the affordability factor. Now, we did have an infusion of, some say 10, some say 15, some say 20 million people coming here from other countries. Now, it seems like some of them have self-deported. They say about 1 million have self-deported. Um, and we're seeing some of that maybe go away. But that gives reason why I bring that up is more people means the need for more housing. So that, causes pressure for, the housing affordability. Obviously, it also can cause some issues for wages. But we just saw a 2% increase in wages, which of course is a good thing. But the Fed, wants to see higher unemployment. Single family under construction has gone down, and single family completions is is up a little bit, and actually the new home build at the moment and the completions is good, but looking ahead, not because this is really new inventory. Resale homes, about 75% of them or so, those people are going to go out and buy a house, right? So back in 2008 during the crash, a lot, we had much higher inventory, 250. Uh, let's see if I have the chart here. I've got it someplace. Where is that chart? Um, oh, here it is. We've got, we had 250 to 400,000 per week for many years. Last week's new listing data over the past 2 years, 2024, 2025, you can see it's nowhere near that level at all. Okay. So keep that in mind when we hear about the crash and we've got some of this clickbait out there. Oh, we've got so many more homes here in the Phoenix area and certain parts of the country. Well, yeah, but when you go, you got like in the 20 some thousand at any given time here in the Phoenix area at the moment, over the past year or so, and there's definitely been an increase in inventory, but that's going to be a good thing because if rates drop, uh, you're going to want that backstock of inventory. And again, a lot of that are people who are also going to go buy. So the new homes is why I wanted to stress this week. Housing permits are at, and remember during the crash in the Phoenix area, we had like, was it 56, 58,000 homes for sale during the crash. So we're in the 20s. We're nowhere near that. We're just kind of like in a balance, really a balanced level. It's just these interest rates and the prices of homes going up with the inflation we had over the last few years, which is now way down, caused the affordability crisis. But housing permits and starts, again, we can see, housing activity at COVID-19 recession levels. And now we can see, we're not going to be getting that new inventory that we want. So there's going to be upward pressure on pricing. All right. Now there's going to be more homes to pick from and choose from for buyers that are out there in the market. So that's a good thing. And when rates do drop, which I'll get into here shortly, and what it's going to look like, that's, we're going to want that extra inventory. And even people who've taken their homes off the market may relist too. So, home builders confidence index is almost back to new, to the lows of COVID-19. Okay, again, we just see this traffic of buyers, uh, present sales, builder confidence. It's all dropping off. See that next 6 months. So the Fed is causing a big portion of this. Obviously, the prices been elevated, but with that extra inventory that we have, and even people that may put their homes back on the market, and that's going to be nice to have that extra inventory to work from. This is actually, kind of like our pre-pandemic levels, basically. And you got to remember when they throw these numbers out, all these extra homes that are out there, a lot of those homes are either dirt or under contract. Okay. In other words, they haven't been built yet or they're under contract. So that's another factor. Some of these, like Redfin and stuff, they'll throw all these wild numbers out there, but they're not really breaking it down that way. Where, hey, 500,000 of those are under contract already. A lot of this is just dirt, hasn't been built yet. Now, here's one big indicator. Okay, understanding the importance of residential construction, and I mentioned this before, to the economic cycle and job market is crucial. When workers in residential construction lose their job, a recession often follows. This is a pattern that the Federal Reserve and Powell tend to overlook repeatedly, though Too Slow Powell is his nickname now. Throughout various economic cycles, he was late to the party many times, especially when he started raising rates in 2022. He should have raised them a little bit earlier and not so high, and we would have been fine. In other words, he should have been more at a Fed's fund rate, which affects the 10-year Treasury, which then affects the bond market, and then by about let's say 75%, 65 to 75%. And then that 10-year Treasury is where we can follow mortgage rates, because mortgage rates tend to, we call it the slow dance with the 10-year. And you normally see about 175 to 2 point swing between that and where mortgage rates are. So, um, because they tie in together. But all employees, residential building construction, this is actually right now, it's still elevated. Okay. We saw a little dip here, of course, back in 2020, but it's elevated at the moment. But with all those numbers going down, what might happen coming up? It doesn't take rocket science. Now, one good thing looking forward is that we have purchase application data. Okay, we have -3% week to week right now, but we have plus 14% year over year for mortgage application data. That means people going out to get home loan pre-approvals with the idea that they're going to go out and buy a house. Okay. So the streak, definitely continues at 20 weeks year over year growth. So we'll kind of see where that goes. I think I have a chart of that. Let me see here, right there. Whoops, sorry about that, guys. Okay, so we can see that we've got a little bit of a drop off here right now. Okay, like I said, week to week. Okay, -3% week to week, but it has been elevated. So overall, we've been doing good there, and that kind of tells us where we're looking at things over the next 30 to 90 days. Now, remember, we missed, we're missing out on the peak season, which is usually always in the spring. Okay, if rates were to drop, okay, uh, later on this year, we could see a little run at the end of the year, but I'll talk about that in just a second. So, in conclusion, he says. Yeah, as you can see, the housing market is critical not only to fight inflation with supply, which is the best way to deal with inflation, but also a key economic cycle indicator. Expect increasing pressure on the Federal Reserve over the next 6 months or so. Our economy is facing several challenges that have confused the Fed and led to more passive approach in their decision making. So this is super important to understand that what's going to happen is um, we're going to have tremendous pressure on the Fed, which I'll talk about more as we go along. So, okay, um, now let me jump in here and okay, I've got some more charts for you here that I wanted to show you because there's a lot of concerns out there about these things. Again, total inventory. What's that show you? Way down, right? Total inventory way down. Okay, can't have a crash if you have inventory down. That's why that chart's important. Okay, the number of foreclosures, bankruptcies are still below pre-pandemic levels. You can see this is where we were over here in '09, '08, all that. Now they're elevated slightly, and of course they were down during the pandemic. They're up slightly, but nowhere near this. Nowhere near this, guys. So we're not seeing that. Okay. Um, the other thing is existing home sales. Right now, they're just kind of holding steady. Right now at the very moment they are down a little bit, and you can kind of see where we were. During 2020, 2021. Um, the New family houses sold again up, but forward looking, we'll see how that application data holds up. And with the building that they do right now, that building portion is not looking great. One of the other things, I want to point out again, I point these things out before. Here is kind of a list that Logan Motoshami put together of all the, reasons why things were going to crash. Okay. And as you can see, if you listen to the legacy media, these are and all the experts, this is what we were looking, for all the reasons why the housing market was going to crash. So if you listen to that, you were going to be out hundreds of thousands of dollars. Now, when we look at this chart, this shows us kind of housing long term. You had one little downturn here uh, back in 1990. Okay. And again, during the crash, of course, that everybody wants to go back to or talk about, you had that. Other than that, housing has been up even during other recessions. Okay. So now this is the personal consumption expenditures, PCE. Again, that's down. So as far as inflation goes, it's down. Could there be a little one-time adjustment with some of the tariffs coming up? There could be some one-time adjustments, yes. But there's other ways to get some of those products, okay? And again, if there were an issue with the tariff and the countries weren't eating it, which I think they will eat it, and a lot of times there are competitor countries, or things maybe we can even make ourselves, and it's going to take certainly several years for a lot of the other manufacturing to come back, no doubt. But um, there's that aspect, and then we might see a temporary issue with oil prices, and that's a concern that they had that Powell brought up with the war in Iran. But a lot of that has to do with uh, uh, you know the idea that we need to buy oil from Iran, which right now we just had a big rally with the idea that we're opening up a bunch of new permits for drilling here in the United States. So I think that will overall that'll balance itself out. Okay, is what I'm getting at. So um, all right. So right now with the before I get into that, let me just and I swear I'm going to tell you exactly where we're going to end up here with these rates. Okay, um, over the next 6 and 12 months, and it's going to be some good news. Affordability challenges in Arizona. We had the Phoenix New Times come out with saving 10% down. Now you can buy a home with 1% down, 3% down, 3.5% down, 5% down. Okay, They're telling you how long it would save for a medium price home in the area. Wyoming's the most affordable state right now. Beautiful place, but not too many people are necessarily moving there. Home ownership costs have skyrocketed over the past 5 years, less affordability. Uh, Obviously, insurance, and especially in certain areas of the country, is a big deal. Overall, insurance has gone up for everybody, but especially places they're mentioning here in this article from Zillow, Miami to Sacramento. Obviously, hurricane season's one issue. You've got fires, forest fires, all that sort of thing. That can impact your costs on a mortgage because you have to have homeowners insurance. um, Luxury market here for the Phoenix area, our luxury market, medium luxury market, it's really at 2 million now, which is insane. I remember when it was 500,000. So, affordability for luxury markets, you've got Detroit, Cleveland, Pittsburgh, some of the other areas to look at. Some of the rental trends right now, Phoenix suburbs like Glendale have 42 percent renter households. Peoria, uh, over 2,000 rent households. That's gone up. In Goodyear, it's gone up another 1,600, almost 1,700 rent households have seen significant renter growth. But keep in mind, all these big projects for multifamily homes and stuff, they've died off. I don't have the chart here, but they've dropped right off, and those have been completed or being completed. Um, that started up during the pandemic. So a lot of that's pretty much done as far as being built for multifamily. So that's kind of waning as far as that goes too, which is going to cause a little bit more pressure there for the rental market. Sun Lakes had the fastest renter growth in the region here in the area at 41% over 5 years. Nationally, over 200 suburbs in the 20th largest metro areas are now renter majority, driven by the affordability challenges in purchasing a home. A big part of that is the interest rates. Obviously, prices, yes, but when you take an interest rate of 100 basis point difference and you look at, let's say, $10,000 decrease on a price, 1%, you may be saving 250 to 300 bucks a month versus 10 grand on a price reduction where you may be saving 80, 90 bucks. Okay. So the interest rates do play into this big time, obviously. Home price outlook for 2025. Now, Housing Wire is predicting 1.6% decrease in Arizona for 2025, offering slight relief after years of increase. That's obviously going to be dependent on the area, the home, the community, subdivision and all that, or not in a subdivision, those sorts of things. So we'll keep an eye on that. Nationally, right now we're up a little bit in the area. I think where it was last time I looked, it was around 2 or 3%. So we'll see how that goes with some of the other things I'm going to talk about here in a second. Nationally, median asking prices are 1.3% higher than 2024. Again, traditionally, you get about a 2% increase or so year over year. It's kind of the average nationally for us here, 5%, maybe 6%. That's kind of like the range that we're kind of used to here in the Phoenix area. And it says with 39% of homes on the market seeing price reductions, a 15-year high. So, increased listings and slightly reduced demand contribute to a buyer's market in Phoenix. Okay. So, um, you know, one one big thing is the buyer demand and mortgages. Okay. So we see that despite the availability challenge, purchase applications are up, as I mentioned earlier. Current 30 year fixed, I think right now we're at 6.8. That's the average across the country. You can get lower than that depending on the type of loan you have right now. If you're working with a mortgage broker where they shop the best rates, you can get a buy down. Right now is actually a great time to be a buyer in the greater Phoenix area and in a lot of markets because of these issues that we're talking about of affordability. So you can get price reductions, you can get buy downs, you can get assumable mortgages where you assume the kind of go back in time, assume that owner's lower mortgage rate that they already had. Um, So the Federal Reserve didn't cut interest rates. Um, right now they're at 4.2, 4.5 at the June meeting that they just had, with only one, maybe 1 to 2 cuts expected this year, if at all, from them, of 25 to 50 basis points. So now here's one thing, and this is just one thing. Okay, over the next 3 to 4, maybe 5 months, Scott Bessett's going to be uh, taking off some of the regulations with banks, and that could cause an additional 30 to 60 point decrease. Okay, this is just one way we're going to see some good news. Okay, I'll talk about the rest of it here in a sec. This is one way we may see rates drop, because it's going to allow the banks not to have all this extra money in reserve, and that will cause them to be able to lower some of the fees, which basically bring these rates down. So the Treasury Department's going to be working on that over the summer. So hopefully by the end of summer we see that happening. And of course they're waiting on their big beautiful bill. We'll see how that goes. That's going to be a big thing too, with inflation and dealing with things like this. The other big thing is a shadow Fed. So um, what we're looking at with this shadow Fed thing, we've got Pulte, Trump, Bassett, all these guys. They're wanting to get the lower rates, so they're going to be coming out with different. You're going to see stuff coming out over the next few months, like with what Scott's doing. You're also going to see the shadow Fed, which is not just a pressure campaign and just say do it, do it, do it. It's going to be, look at what inflation is doing, maybe look at what's happening with certain sectors of the labor market. There's going to be all this data coming out, and there's going to be tremendous pressure put on Jerome Powell at the Fed chairman, to lower those rates. Now, his term is up in May. And what Trump has basically called for, where he thinks rates should be at the moment, are 2 to 2.5 percentage points lower, okay? Or 200 to 250 basis points lower. What does that tell me? That, I think you're going to see whoever he's going to pick will emerge soon, along with these other voices, and that person will be throwing out a lot of the data and why they're right and Jerome's wrong, which I 100% agree with. Okay, I don't think people need to lose their jobs to lower the Fed's fund rate. Okay, I just don't. Um, but um, you know, it, you're going to see that person saying these things and what they're going to do when they get in there. And I think that will really drag Jerome along to maybe do nothing near what he should be doing, but I think he'll maybe do 1 or 2 cuts like we talked about earlier, and then when that person is replacing him in May, there's been some names thrown around. I gave them to you last week, but that person will be forecasting where they're going to be. So you see the bond market get ahead of that, probably by early next year at the latest, by spring of next year into the summer, we'll see much lower rates. How low? Right now, the way the environment is and what's being talked about and everything, I could see again 200 to 250 basis points lower, plus what Scott's doing. So where could rates be by next, May or June? Um, they could be, I think, anywhere from 4.25 to 5.25, depending on the economy, the bond market, and all that. So um, keep an eye out for that, guys, because that's going to be huge. That is going to skyrocket our housing market. Okay. Again, anything can happen. We're dealing with wars and oil and all these different things, but I think we're going to see another boom to the housing market. So if I were a buyer right now and I had to move, could afford to move, I'd buy now, get all the deals and buy downs and price reductions I could get, but especially the lower rate programs that are available to you. where right now, whether it's a new home or a resale, you could get, you know, uh, that lower rate. And I'm talking right now, I mean, with the new builds, you could start your first and second year, way lower. I mean, I've seen 2.9, 3.9, paying all the closing costs and everything. And then later on, when the rates drop on their own and your rate goes up after that second or third year, then you could refinance, no out of pocket cost, and because you got the buy down rate, there's already money that's going to be still sitting in there that was paid for by the seller or builder that you can use then, but not only no out of pocket cost, but no cost at all or very minimal because that money's already in the account. When you do these buy down programs, that money sits there so you can use it later. So if I were thinking about buying, I wouldn't wait for the rates to go down. I'd get the lower rate now. Okay. And we could show you how to do that. If you're thinking of selling them, buying now, whatever, let's talk about your options there. Get the lower rate now, and then later when you can get a good fixed, do that. Okay. So let's jump right back in here. Right now, the 10-year treasury, again, plays hand in hand with the mortgage rates. Okay. Should be 175 to 200 points. Right now, we're at 4.3 at the end of the day with the 10-year treasury trading. And our average 30-year fixed is 6.8. Okay. See how these other ones are lower too from compared to that? VA is lower. Obviously, if you're doing less years, it can be lower. But that should be right now, 6.3, but it's not. It's 6.8. That'll change when Scott does some of these changes and we see the Fed finally be run like a real Fed. Okay, that's going to change too, and we'll get back where we should be there. So that with the splits we call them between the 10-year Treasury and the uh, average rate, that's going to automatically lower rates too. The bond market will react immediately from the restrictive nonsense that we've been dealing with the Fed all along. I mean, and you know, the Fed did raise rate or did lower rates under the last administration while inflation was higher. So, just saying, uh, for what it's worth noting, I guess. Okay, for the Greater Phoenix area, this is the Crawford Market Index. So what this tells us is if we're in a buyer, seller, or balanced market, under 90 on the market index is a buyer's market, above 110 is the seller's market, and from 90 or 100 is completely balanced. So if supply and demand are the same number, this number would be 100. Right now we're at 72.3, so we are in a buyer's market in the Greater Phoenix area. See, I wasn't making that up. It's a great time to be a buyer. And now, if you're thinking about selling a home and buying, and you're like, but I want that higher price. You do have to price for the now, what's happening right now. Okay, in this kind of a market, you can't play games with the pricing. This isn't 1980 where nobody could see all the pricing and comparative sales online. Okay, and if you have a good agent, they could even give you some recon and insider information on properties that are even under contract, and what the foot traffic is in the area, how many showings are happening in the area, what kind of traffic they're getting on open houses and things like that, what kind of features the other homes might have and stuff. So it's really important to really know your stuff here, and that's why we track this stuff every week. But we're seeing if we list a property, price it correctly at the right pricing brackets, the way people search, and I can explain to you how that works. You'll be able to sell your house. Maybe you won't get as much as you want for at the higher level, depending on the features and upgrades you have, but you'll be able to sell it for the now market value, and you'll be able to get a smoking deal, so you'll make that up on the purchase. Okay, does that make sense? All right. So, I mean, whatever market we're in, you just got to play in that market. And people don't move just because rates go down. They move because they need to move or want to really move, whether they're upsizing, downsizing, moving for a job, family, whatever, okay? Or a lifestyle. A big part of home ownership is lifestyle. So, Um, Supply right now is a little bit elevated, but you can see it's not in a crazy range, okay? Because it's right up here near the middle. And the demand, okay, that we're seeing at 78 is it's not horrible, but it definitely, we're seeing that number just kind of hang there at that 78 mark. Now, as far as where we are on the contract ratio, this tells us in the now what's going on is slightly higher over the last two readings, but nothing spectacular. This is what is for sale and what's under contract. So from this standpoint, we can see that we're, if we look at the chart here, a hot market would be 60. We're not at 60, okay? We're at 32, just a little over half that. So the number of properties under contract is 76, a little over 7,600, active 23.5, okay? Um, so anyways, if you guys have more questions, please make sure you follow us on Facebook, Instagram, in YouTube. Subscribe, follow us, give us a like if you like the information here. Share it with some friends, share it on your pages, and if you have any questions, feel free to reach out anytime. We'll make sure we have all of our contact information here below. If you're getting our newsletter, you'll also see some other videos listed here below in the playlist. And that's all I have for you this week. You guys have a great weekend. Thanks.